Hello, everybody. Welcome to another edition of the 1Mby1M podcast. I'm here with Greg Borchardt, Caerus Ventures. Greg, welcome to the show.
Thank you for having me, Swarmana.
So tell us about Caerus Ventures. What is your sweet spot? What is the size of the fund? What kind of investments do you like to make? What's the focus? Let's get to know you.
Sure. So Caerus Ventures is an early-stage venture capital firm. We're based in South Florida, actually, and we are a female-owned firm. We are on our second fund. We're actually having the first close into our second fund this quarter, and the new fund is a $100 million fund. We, currently are actively doing diligence on several startups with the expectation of investing actively again beginning in early April, although we have warehoused a couple of companies for the new fund. We are seed and Series A investors, and we actually focus on the connected hardware tech ecosystem. So it's a bit of a differentiated strategy from many of the other VC firms out there, and we feel that it's one where we have, a real competitive advantage.
Very interesting.
So in terms of just the check size, before I get into more of our investment thesis, we generally will write our first check in a seed round or an A round. Typical check size, can range anywhere. It's a pretty broad range from, say, $200,000 to $250,000 up to maybe $2 to $3 million. And we'll generally follow on through at least the Series B round. We do allow our larger investors to invest alongside us in sidecar vehicles so they can co-invest. Yep. And, if we decide not to do our pro rata amounts after a B round, our some of our larger LPs may be, are able to do that. We've really spotted, we feel, a mega trend where high-powered, internet-connected, or I should say cloud-connected computers can be purchased for nearly nothing. So we're seeking to invest in early-stage startup companies, again, at the convergence of hardware and software.
So let me probe that a little bit more, Greg. It sounds fascinating because it is, as you point out, it is a differentiated investment thesis. So I'd like to understand the investment thesis. Before we go there, I want to ask you about geography. You said you're in Florida. Is that the region where you invest as well, or is the investment more national or global?
It is a national investment. We do look in North America. We tend to find more companies, I'd say, on the East Coast and in the Midwest and the Southeast, simply because while we do have a portfolio company in San Francisco, generally speaking, if some of the West Coast deals are getting to us, unless there's a true strategic fit, they're probably not the best deals that we're seeing. We, given our thesis, and especially really focusing more on the connected hardware space, and I can delve into that a little bit more. It's not only hardware companies, but kind of all of the companies within that ecosystem, including, software, sensors, big data, et cetera, are being built not just in Silicon Valley, but are being really built across the United States and across North America.
And let's then talk about the investment thesis. What would be really interesting as a starting point to understand your investment thesis is to do some examples. So this is your second fund. You've already used this investment thesis and invested your first fund in a bunch of companies. If you could take us through a few examples that illustrate how you think about your investment thesis, how do the companies that you have invested in fit that investment thesis, and what is unique, what is interesting about those companies, that would probably be the best starting point to understand your unique investment thesis.
Sure, and to be honest, it's been a bit of an evolution. Our first fund was a smaller fund. It was in a sense a fund in which we built our track record, and we took a more generalist approach That fund was, I believe, the final close on that was approximately 3 years or 4 years ago. So we've been making, investments out of that fund over the past 3 to 4 years, and we're actually just about fully committed that fund. We've just been, doing follow-on rounds into our existing portfolio companies at this point. And what we learned in the first fund is that we really had an expertise in the connected hardware space. My personal background, actually, I ran a few startups, but I somewhat grew up in the consumer electronics manufacturing industry and have spent a bulk of my career prior to moving to the investment side in the kind of consumer and enterprise electronics manufacturing space. And so we started, as I was trying to say, we started to see a mega trend emerging where, CPUs are starting to get embedded into, really every consumer, industrial, and medical device that are creating efficiencies and personalization that's never seen before. So all hardware is becoming smart and connected, and traditional hardware devices are now being powered by software and use sophisticated sensors, computer vision, AI, and machine learning to collect valuable big data. Hardware technology is no longer a one-time sale. There are true opportunities for recurring revenue streams and strong use cases for the blockchain, which is an emerging technology that everyone knows. I would say looking at our first fund's portfolio, for example, 2 companies come to mind. One is a company called Sculpt, and that's actually a company it straddles the medical device and the consumer health and wellness technology space. I met the founder actually at an Angel event and down here in Florida, and they were at a point where they were generating revenues. They had this medical device in the market, and this is going back to a time when all of the activity trackers were just coming onto the market, the Fitbits and the Jawbones at that time.
Right.
And, we weren't necessarily interested in those products. We felt that they were becoming commoditized. There were a lot of Me Too products, but what was interesting to us about Sculpt was they were actually not just tracking activity, they were measuring results, and their focus is actually on quantifying muscle health. And the origins were in a medical device that was being used by top pharma companies and researchers to quantify muscle health as it related to neuromuscular degenerative diseases. And when I met them, they were looking to cross over into the consumer space as well because they saw a strong use case for this same technology on the consumer side. And so that was an interesting thesis for us. We got involved very early on. We led their, let me think about this. We led their we invested in the seed round, led the A round, and they subsequently, raised a B round. And, the people that participated after us, one was a larger West Coast venture capital firm, and another was a large Chinese strategic global manufacturing company. So, we felt like we were able to find a deal like that, get in sooner, and have.
And what is the go-to-market strategy for this company?
Excuse me? The go-to-market strategy?
What is the go-to-market strategy?
So there are 2 sides of the business, and they are they started off in the medical device space, and they created a consumer product that we helped them really, down the supply chain to develop, price, source the components for the product, and ship it over to the U.S. They initially launched the product in the United States. They started initially online only. We felt that it made the most sense to get feedback from the early adopters, the core users, and be able to kind of iterate from Gen 1 to a Gen 2 product based on the early feedback we were getting from the heavy users. And then they subsequently launched the product at some major retailers in the U.S., including Best Buy and Target, and as well as a few overseas markets through master distributors in those territories. For example, for Western Europe, for example, or the
And
UK.
they're seeing good traction.
Yeah, and they're seeing good traction. And what we've kind of learned that there is an actual very profitable space in between the consumer market and the medical market. The consumer market, it can be a very difficult market and somewhat more fickle, just in general, not only related to this company. But what we've seen, and it is actually part of our thesis for the new fund, is a real convergence between what used to be truly just medical device and what used to just be, a consumer product. That this kind of people are taking more control of their personal health data, and there are more ways to collect data, maybe, from a mass market device, an Apple Watch, for example, or a Fitbit, and connect that data back into a more robust ecosystem that, eventually your doctor can track or may flag the potential for a heart attack, whatever it may be. And so this company in particular is actually kind of going in between those two markets right now and developing a new product that works with a lot of the kind of more sports medicine, physical therapy, et cetera. That's a very interesting use case as well.
Cool. And any other example that you want to discuss?
I guess the other company that I could discuss, there are a few. Let me see. I can focus on maybe a company called Caerus, Kairos. And they're a local South Florida company and based in Miami, and they're in the computer vision space. So this isn't, a pure hardware tech company per se. I had met the founder going on, 4 years ago approximately. And again, I believe he was actually maybe speaking at an event. And he, at that point, the company was basically facial recognition solely focused on the HR space. So instead of a traditional clock in, clock out punch card system, this was, supposed to prevent fraud, and it was going to be used through facial recognition. And at that point, we just didn't feel like it was, necessarily ready for true venture investment. But I liked the entrepreneur. He was very intelligent, very personable. I respected what he was doing, and we kept in touch. And it was really over a 4-year period that he finally came back to me and said, look, I think we're ready now. And they built out the technology, they built out the IP, and it was no longer just facial recognition, but it was also more of a human analytics platform that combined facial recognition with emotion analysis and crowd demographic analytics technology. So, this was, from a macro level, computer vision, something that we were interested in. But as he built out the technology, we saw a broader use case, ranging from digital signage industry to autonomous vehicles. And so, we got, we made an investment at that point, and, they've continued to grow the company. And actually, this is somewhat unique. This is the first company in our portfolio that is actually, for their B round, has gone out and done an ICO. And we're supportive of it. We're still somewhat of a learning process, I think, for everyone involved. But they are just closed down the pre-sale of a $30 million ICO that was 20 times oversubscribed in a matter of weeks.
I don't understand why this is a good fit for an ICO. I mean, what is the token angle of this business?
Well, there are a couple of things. One, they are issuing both a security token, so this is a fully regulatory compliant issuing, similar to an IPO. And two, people are also receiving utility tokens. And the tokens are related to the database of basically personal identity, computer vision recognition that the company is building out. And obviously, as an investor, we're determining the best pathway forward because we're preferred shareholders. And what does that mean? We have an opportunity to convert into a token that will be traded on a marketplace, or the security token. So, there's a potential chance for liquidity for us. Very similarly to what happens in an IPO, there will be a 6-month lockup, et cetera. Or we can decide to hold our preferred equity in a company that, has raised $30 million. And I think this really brings up a lot of interesting issues going forward as what it means for early stage investors, seed investors, because thus far the majority of people raising money in ICOs have been really just doing it through a white paper and it's a concept. What starts to happen when you have companies with real revenues that have been around for 6 or 7 years doing it? And, is that a positive or a negative?
I'll tell you where I'm a little bit uncomfortable with what you're saying is that I don't see the token angle of it. I think your point is well taken that, somebody with a proven business model and so forth doing an ICO is a more interesting scenario than a, concept financing and concept ICO. All that is well taken. But why do I want tokens in this, in this ecosystem, in this exchange?
Well,
that is the question. There are certain businesses that are very token-friendly businesses that are where the tokens will naturally float around and change hands and create a natural liquidity process. And there are certain businesses that have that characteristic, and there are others that don't have that characteristics, which, in my opinion, should not be doing ICOs. So in this case, I'm struggling to understand what is the token angle of this?
Well, and again, I think there are two separate tokens that the company is releasing. And again, I don't work for the company. I am an investor in the company. I'm not on the board of the company. However, they are, I think there are two things to look at. One is the security token. So what does the security token do? It is, basically gives investors the ability to invest in the company and participate just as, as it was, say, investing in a piece of equity. And so
that sounds more like equity crowdfunding than an ICO, right?
From a security token perspective, I mean, that's how security tokens work. It is, similar to, an equity stake. I think from a utility token perspective, that's much different. And, a utility token gives the user, an access, for example, to a database that is, built on a blockchain architecture. And so I think it's two different things, and I think there are different values to different people within that. Yeah.
All right, let's move on. If you look at based on this investment thesis, if you look at the last 12 months of deal flow, what trends are you seeing? What kind of connected hardware ideas that are out there and that you think are interesting and are throw light on emerging trends?
Yeah, do you want specific deals or general industry? And then
just general ideas, just more trend questions.
Yeah, no, I think, again, we're starting to see technology become more and more disruptive in maybe industries that weren't as tech-dominated. So, for example, agriculture, we're seeing some interesting agricultural tech products. Technology in the retail space, in the smart cities, obviously, is a somewhat larger, all-encompassing one that includes construction technology, et cetera. And I think, obviously IoT, industrial IoT, and some of, the related software that goes across some of these industries, such as whether it's computer vision or AR, VR, we're starting to see, a lot of different deals through M&A acquisitions, for example, where non-traditional tech companies are starting to acquire tech companies, whether it's, just, I think it was announced yesterday, Walmart buying Spatial Land, which is a VR company, and most people think that's going to be related to the in-store shopping experience. Or, Target buying Shipt, or I'm trying to think of another, Mars, buying Whistle, which is, a pet tech company. These are companies that maybe weren't doing tech acquisitions in the past. Johnson & Johnson's another company that recently has been doing some tech purchases. So we're starting to see companies from a variety of non-tech industries either invest in or acquire hardware tech companies and even some software tech companies as well. And
you mentioned agriculture. What are we talking about? Monitoring kinds of use cases? What are the trends in agriculture, in construction? What kinds of use cases are we seeing?
Sure. So, I think in agriculture, for example, we've seen a substantial amount of companies doing monitoring, and that can be for, soil quality, moisture levels, others with different types of sensors that are sensing for disease, amount of sunlight, crop yields, things like that, or things that affect crop yields, and trying to gather big data and connect it to the cloud so that they become somewhat more predictive, because they may sync up with what the weather patterns have been over the time that they're collecting the data, and then look forward to what is the weather forecast and what recommendations are being made to the farmers. And so we've seen companies in just general agriculture, in viniculture, if I'm saying that correctly, the wine industry. We have actually seen a company that is focused more very specifically on the golf course industry, which is actually one of the largest water users in the nation and in the world, and as well as agricultural chemical users. So it's one, obviously they're trying to help the golf course owners, the maintenance people, maintain the course as well as possible. But beyond that, if they can, there is somewhat of an eco-friendly play there, because they can maximize the water use efficiency as well as the chemical use efficiency. So things like that are interesting to us. I think we've seen... It sounds
like the overriding thread tying together all these use cases is there is a sensor that is monitoring a bunch of stuff, collecting data, throwing that into the cloud, and there is a predictive analytics kind of application on the software side. That's the general architecture.
And there's infrastructure around that, whether it's the rollout of 5G and how quickly people think that will or will not happen, and narrowband IoT and various things that need to be put in place, to determine whether is this something that a farmer can be the owner of, the usage of, in a sense that they maybe either own the drone and it's an autonomous drone that they can put outside each morning or once a week, and it can fly a predetermined path and bring back all the data. Or currently we see more of a model where it's almost more of a consulting basis, where you have companies go into larger farms on a, say a monthly basis or less, and more of a consultant model that they bring the drone, they gather the data, and then they give a report to the farmer. And how does that, continue to evolve over time?
Yeah, very interesting. I'm going to ask you a slightly different question. Given what you are doing, it sounds like there must be tons and tons of niche use cases out there of your model. And one of my observations that we are in, 2018 February, there's a ton of stuff that have already been built, and some of these use cases, especially when it comes to niche use cases, these are not necessarily all billion-dollar TAM use cases. Some of these are smaller opportunities, smaller niche opportunities, and you can build great businesses with $1 or $2 million in investment, and these probably can be, good acquisitions for other larger companies for $10, $15 million. And in some cases, maybe, slightly larger, some slightly smaller. You could be investing $5 million, selling for $25, $30 million, or investing $250K to $500K and selling for $5 to $10 million. Somewhere in, all that spectrum where there's a smaller TAM and smaller deal size. Is that something that's interesting to you?
I think my non-answer is it depends, and let me try and give a better answer than that. I think we look for deals where we can be happy without needing a multi-billion-dollar IPO. So, for example, if we can invest in a company at, say, a sub-10 or a sub-$15 million valuation, and that company is maybe sold for, 70, 80, 100, 150 million, look, yes, we're very happy with that. In fact, we feel that the majority of deals out there happen through M&A, not through IPOs, especially in the current landscape of investing, where we see a lot of people playing at the seed and pre-seed stage, and then some much larger funds. For example, SoftBank is the biggest of the big, but the traditional VC firms that have been extremely successful are raising larger and larger funds.
Right. Yeah.
So there is that kind of lack of investment in the middle, and so what does that mean? For startups, are they either going to get to a point where later stage investors come in, and then the exit isn't going to happen until probably longer than it's traditionally been or historically been, simply because someone investing $1 billion or $3 billion needs X times that in order to be happy with their exit in the later stage. Whereas, for the earlier stage investors, especially at the seed stage, they may be perfectly happy with, an exit of, 50 to 100 million. Now, if you get to more of lesser than that, I think it really depends on the type of company, and if it's how niche of a market it is. We personally, aren't going to look for a company that maybe we invest in it's a sub $5 million valuation and look to exit it at a 20 or 30 or $50 million plus. I think we're playing a little bit later than that. In fact, because we've seen a lot of investors pile into the pre-seed and seed stage, we're actually looking at a lot of deals lately that are more seed to A. And I hesitate to call them by specific stage names because I feel as though stages have changed. What was a typical seed or Series A deal, say 5 years or 10 years ago, is no longer a seed or A deal. It's shifted. Series A deals are much larger. Seed rounds are much larger, and you're seeing more pre-seed rounds happening. And I think even beyond that, geography affects what is a seed or what is an A round. I can tell you an A round in the Southeast is generally less than an A round in the Valley, or an A round in the Midwest, or Mid-Atlantic is also a lot less than an A round in the Valley. So, those are just labels, but, we look more at valuation and the size of the round in general.
Yeah. Okay. Any other parting comments that you have for our audience?
No, again, I think we just really view kind of connected hardware as the next mega trend in the sense that the smartphone powered the last generation of innovation. We just see with rapid prototyping tools and small batch production, cheaper components, open APIs and SDKs, it's become a lot more cost efficient and faster to scale some of these connected hardware companies. And there's also been a real recent boom in hardware-focused incubators and accelerators that are creating truly investable startups. We love, startups with strong teams, because in our mind, we need to obviously buy into the product or the technology that's being built, and it's great to see traction and have a large total addressable market. But it's really up to the team to execute. So we focus a lot on the team, and we love getting to know the founders and try and be value-add investors wherever we can.
Great. Thank you, Greg, for being on the show. Thank you, audience, for coming today. And we hope to also see you at one of our free mentoring sessions on any week. We have them every week online. Or you can come see me if you're in Silicon Valley at one of our rendezvous. So one way or the other, hope to connect with you and actually work with you on your business on one of these sessions. Thank you for listening, and we'll be back with another edition of the 1 Million by 1 Million podcast. Thank you very much.